following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
Hello, everybody. This is Mark Longo from the Options Insider Radio Network, and I'm breaking into your regularly scheduled programming to let you know about an upcoming event that I think is going to interest quite a few of you. It's called The Future of Options Trading, Finding Edge Outside the Pit, and it's going to be held on November 5th here in Chicago. This is the inaugural conference from the Options Alliance, a new industry trade association that I am privileged to be a part of. And this conference will address the numerous issues facing the fastest growing segment of the options market, namely options entrepreneurs. So who is this event for? Well, if you're a current or former market maker and you're looking for some ways to leverage that unique skill set in some exciting new areas, well, then this event is for you. If you're an aspiring entrepreneur and you're hoping to learn a little bit more about the options market, which is the most dynamic segment of the financial marketplace, but also can be a little bit intimidating, well, then this event is for you. And if you or your firm are looking to expand the reach of your products or services by learning more about the unique needs of options entrepreneurs and new startups and new ventures, then this event is definitely for you. We've got a lot of great speakers lined up covering a wide array of topics, including how to leverage that trading and market-making mindset and skill set into other unique opportunities, also overcoming the typical roadblocks and stumbling blocks that may lay in the path of a new option startup or entrepreneur, and of course, perhaps most importantly, how to promote and market that new option startup or new venture that you're planning. Now, I've been to my fair share of options conferences, so I could say with some certainty that there's never been an event quite like this. Take advantage of this unique opportunity to meet with and learn from the entrepreneurs who are out there doing it, building new businesses, starting exciting new ventures in the options market. You can learn more by surfing on over to www.optionsalliance.org and then clicking on the event sign-up tab at the bottom of the page. A lot of people say that their space is limited, but we really do mean it. So if this event interests you, reserve your seat today. Thanks for listening, and now I'll return you to your regularly scheduled program.
It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews with leading advisors, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. And now, it's time to arm yourself with the latest weapons in the war on risk. It's time for the Advisor's Option.
All right, everybody, that stylish, suave, Bond-esque tune means it is time once again for the Advisor's Option, the program geared towards busy financial advisors who want to learn more about options and some practical ways that they can implement options into their client portfolios. My name is Mark Longo from the OptionsInsider.com, as well as from the Options Insider Radio Network, upon which many of you are listening to this fine program right now. And I am joined by a great cast of contributors, a great crew on the old panel today. Starting off, I think he gets the Trooper Award on the show today. Starting off, hot off the heels of his global road trip to China, just off the plane essentially, and jet-lagged all to heck, but still making it on the show today, is Alan Grigoletto, the Director of Education over at the Options Industry Council. Alan, welcome back to the program.
Hi, Mark. Happy to be here. Thank you.
So tell us, what were you doing globe-trotting all the way over there in China?
We had a three-leg road trip to Shenzhen, Shanghai in mainland China, and then over to Taipei, Taiwan, where we're looking at the options market that's going to be developed in mainland China. And then in order to provide education to those Chinese investors, we went to Taipei to train their trainers on how to teach in the same methods that we're accustomed to teaching within OIC. So the Taipei folks will be the future trainers over in mainland China.
Now, I've always heard anecdotally from a lot of people who go over there to do that sort of thing that there's just a ravenous demand for options education in that part of the world. Was that your experience as well? Were people really lining up, and were the soon-to-be educators really excited to be getting into this?
Yes, they are. There's probably more demand than there is supply in terms of who has the knowledge on options and the capabilities of delivering it to some 80 million retail accounts that exist in China. So the work will be cut out for those that are doing the training. In particular, the CSRC, which is their regulatory commission, their SEC, if you will, has been nervous about any kind of real rapid or rampant speculation in their marketplace. So they are concerned that investors get the right education on options.
Well, you're certainly the man for the job. I'm glad you can make it. I'm glad you can make it on the show as well. Like I said, you do get the Trooper Award for the program, and I'll be sure to let you rest your voice periodically throughout the show here today.
Appreciate it, Mark.
No problem. Also joining us on the program today, he's usually beaming in from scenic Colorado. He shifted a little bit to the south, beaming in from scenic Austin, Texas today. He is Randy Swan, the co-founder of Swan Wealth Investments. Randy, welcome back to the program.
Thanks, Mark. Glad to be here. I have survived the fires and then the floods, and now I'm getting ready for skiing, hopefully in the next month or so.
Yeah, you've had quite the biblical plague year. I hope you don't take that as a sign that something's lurking on the horizon for you. You said fires, floods, big storms. You said going into Austin just now. So, been an interesting couple of months for you. Hopefully, it'll settle down a little bit.
Exactly. Looking forward to a nice, relaxing winter skiing season.
And we will be joined a little bit later on the program by the newest addition to the Swan team. Many of our listeners know Mark from his other appearances on our network, including the Option Block program, and from his work with the Option Block, but he's actually the newest addition to the Swan team as well, doing a little bit of double duty. So he'll be joining us a little bit later as we dive into the program itself. He's hopping off a plane as well. Everyone's jumping off planes and jumping on the advisor's option today. So everyone's doing their duty to make sure you guys get a great show. And without further ado, we're going to keep on rolling right on into our Options 101 segment.
It's time to learn how to manage risk and generate additional income for your clients. It's time for Options 101.
All right, everybody, welcome to Options 101. This is, of course, the portion of the program where we break down some options concept that we think would be useful for you in your practice and with your clients and in your clients' portfolios. And today we're going to revisit a topic and go a little bit more specific with it. The topic I'm referring to is volatility in itself, and in particular, some specific products that a lot of people are really interested in the volatility realm. If you want a good basic overview, a good basic primer on volatility, I encourage you to go back to our February 20th episode of this program entitled, surprisingly enough, Volatility, where we dove into kind of a volatility 101. We talked about what is vega, what is implied versus realized, what are the different impacts of low versus high volatility environments, how they impact your trading, all those kind of things. So if you want that kind of basic overview before you listen to this episode, again, I encourage you to go back. You can find it on theoptionsinsider.com, on iTunes, on Stitcher, wherever you find your podcast archives. You can find that episode there. It's the Advisor's Option episode from February 20th entitled Volatility, and that will give you a good basic overview. So what we're going to do today is actually dive a little deeper into the world of volatility. In particular, like I said, the one product that a lot of people are really, really interested in, both retail and a ton of advisors. I've had a lot of advisors reach out to me about this specific product. It is, of course, the VIX, or the Volatility Index. But before we even do that, Alan, I know because you work over at the Options Industry Council, you are, of course, owned by the OCC, which is a joint entity of all exchanges. It is verboten for you to discuss a particular proprietary product, and that is indeed what the VIX is. It is locked to the Chicago Board Options Exchange. So before I drag you deep into the VIX waters and get you in trouble, I think I'll give you a chance here at the top of the show. Let's dive in a little bit, because remember we had that show a long time ago about kind of an overview of vol. But now, as someone who spends his days really in the trenches with the advisors and dealing with them and educating them and listening to their questions, let's talk a little bit more generally at the top here. What is their take on volatility? Do you find them to be cognizant of it, A, B, of its impact on their trading in terms of simple things like, vol makes a put more expensive to buy and things like that? And are they aware of kind of this expanding universe of volatility products that from your conversations with them?
Yes. In a nutshell, yes, they're always concerned about volatility, but advisors in general will tell you that they're in it for the long haul, right? They're managing money for a long, long period of time, but yet their clients often get shaken out of the marketplace when there's big volatile movements in the marketplace. So they have interest in designing strategies that kind of protect the downside, because most of the advisors will tell you, Mark, that none of their clients ever wants to go through another financial crisis where your portfolio can suffer, 30, 40, 50% losses, due to a big tail risk event like 2008. So I think they look at vol in the terms of portfolio insurance, in terms of puts, buying puts, but at the same time, they're always cognizant that buying that put can be a drag on the portfolio return.
Yeah, that's the common refrain we hear from advisors. We want protection, but we don't want to spend any money on it. And
exactly.
So they want that magic bullet, which is probably why the zero cost collar is still the number one go-to strategy for so many of them. The notion of a zero outlay is something they can all wrap their heads around.
Or they're becoming a little bit sharper on how they buy portfolio insurance. Now we have shorter term options, so in essence, if they have real fear around a specific event, they can go very short term and buy the insurance just when they need it, rather than paying for long term insurance and paying a much higher premium value for that.
All right, and now we're going, like I said, we're going to dive a little bit more into the deep end of the volatility pool with a specific product. And the reason we're doing this today is because so many of you have written in with different questions and comments about this product. It kind of is the product du jour. It's very hot these days with both retail and a lot of asset managers and advisors, because it has just so much publicity, marketing, impetus, media coverage, whatever you want to call it, behind it. It really has reached a saturation point. I'm talking, of course, about the VIX, the volatility index. You may have heard of this from watching CNBC or reading any of the numerous financial publications out there that seem to refer to it on a daily basis. It's often referred to by the shorthand of the fear gauge. That name is really, I think, one of the reasons why it has stayed around as long as it has and become quite popular. So what are we talking about? Well, the VIX, there's a new version of the VIX, but the VIX has actually been around for quite a while. It started off as, remember listening to that episode from February 3rd, we talked about things like implied volatility. What the VIX initially was the implied volatility of the at-the-money. Remember, we talked about different strike selection on this show many times in the past, the at-the-money being just where the underlying is currently trading. The implied volatility of the at-the-money options in the S&P 100, actually, the S&P 100 index, also known as the OEX, over there on the CBOE. And it stayed that way for a long time. It was just an abstract number that was disseminated by the exchange. But it got a lot of traction. People started to become interested in it. So in around 2003, 2004, they revamped the product. They moved it over to an index that a lot more people follow, namely the S&P 500. So that made a lot more sense for a lot of people. And they also adjusted it a little bit to take into account some other minute variations, things like volatility skew that we haven't really gone into in great depth on this program. Added a few other tweaks and changes to make the VIX a little bit more viable for a lot of people. And then they added, more importantly, some tradable products to it. So they launched the futures first, and then they launched VIX options about a year later or so. And now these products have really taken off with just a broad spectrum of the populace. A lot of people out there, apparently, far more than I ever anticipated, and I think most people ever anticipated, want to trade the implied volatility of the S&P 500. There's just a lot of love for this product. So maybe we'll start there. We are joined now by the newest addition to the Swan Wealth Advisors team. Most of our listeners, like I said, are familiar with him from his myriad appearances on the option block as part of Option Pit, but he's also just joined the folks over there at Swan Wealth Advisors. Fresh off the plane from Pittsburgh or Southburg or somewhere in that area, good old Mark Sebastian. Mark, welcome back to the program, sir.
Hi, everybody. How you doing? It's great to be back.
And this is actually a good program for you to be on because you spent a lot of time over the past couple of years really analyzing the VIX and diving into it as a product.
Yeah, well, that's exactly correct. It's one of the things that I really pay attention to, and it's an index that is very valuable, and the tradable products are great. So it's one reason I trade the products so much.
So I think one of the primary reasons we want to do this episode today is that there's this pervasive belief out there that this product is some sort of ideal hedging tool or some sort of ideal tool to hedge a broad-based equity portfolio. We see a lot of advisors writing into us and saying, oh, hey, that VIX, I've heard about that. I've heard that it's a perfect negative inverse correlation, and I heard that that's a perfect way to avoid a repeat of what Alan was talking about at the top of the show, that tail risk event, that 2008 mega downside event. And so that's why I really, really want to trade the VIX. But maybe even before we dive into that, because the misperception behind that and some of the errors behind that, let's dive into, I think, the number one misperception, and maybe, Mark, I'll toss it to you. Let us run us through this one, is that common perception that people see VIX, aka the VIX cash number, the index number, quoted everywhere, CNBC in the paper, and they think that is the actual number that they are trading, that is the actual number that the options that they're looking at are trading off of. So why don't you walk us through why that is probably the number one misperception around the VIX?
Well, first off, let's talk about why they changed the calculation. Goldman Sachs actually approached the SIBO about changing the calculation originally because they wanted the VIX to more closely replicate what is in the over-the-counter market is called a variance swap, which is a trade that big houses will engage with large funds in order to help them manage their volatility risk. So the SIBO then changed the calculation, then began launching futures. Now, one thing about kind of volatility is that it mean reverts. Everybody kind of gets that. Everybody understands that. Variance and volatility mean revert. And one key thing about the VIX is that all of the tradable assets are European exercise futures. So because you can't early exercise on an explosion, a call, or early exercise a put when things are really low, the VIX futures tend to kind of really lag the actual cash index in movement. When vol is low, they trade at a premium to VIX. When vol is extremely high, they trade at a discount, because in both cases, the overall market is expecting volatility and variance to revert more toward the mean. And thus, when you're trading options on VIX, or you're trading a VIX contract, you're trading a specific expiration month, and that expires, on a specific date. So currently, the active VIX contract is the November future. So November options essentially expire into a cash settlement that is that takes place at the same time the futures expire. So basically, the VIX options, their underlying is a VIX future. So November options, the underlying is the November future. December options, the underlying is the December future. January options, the underlying is the January future, and so on.
Hey, Mark, do me a favor. While we're you sound a little distant. Is your Skype picking up your mic, or I hope you're not using maybe it's using your computer mic or something like that, as opposed to
it must be using the computer mic.
So, Randy, I know you guys obviously do a lot of portfolio overlays over there at Swan. Volatility, a big component of that. Tell me, with your conversations with advisors and just with your own practice as well, what's your take on just the groundswell of popularity in the VIX, and then B, the propriety or perhaps impropriety of advisors really turning to this product as some sort of hedging tool?
Well, actually, our experience is that most of the advisors obviously want the price protection. I think most advisors are not really that familiar with the concept of how to hedge properly with VIX, but that's something that actually it is increasing. It is increasing in terms of the how advisors are becoming more educated and knowledgeable about how VIX can be used to properly hedge their portfolios.
So speaking of that, then speaking of the use case of VIX, we touched on the misperception number one, which is that VIX, this number that you see disseminated widely, is actually just the VIX cash, which is referred to as really just the pure number pulled from the implied volatility of the S&P 500 options and then thrown through this formula that the CBOE created and spits out this abstract number. In and of itself, that's really all it is, just this abstract number. If you want to trade these products, like Mark said, you really have to learn to key off of it and follow the futures and the appropriate options that are keyed to those futures, because when you're trading the VIX options that everyone wants to trade, you're really trading those options keying off the VIX futures contract. So that's probably the number one process step we need to add when you're looking at these volatility products. The number two is getting back to that second one, and like I said, it seems to be growing in prevalence and in the consciousness of a lot of advisors out there, and that is this belief that the VIX product is this ideal hedging component. We see a lot of people writing in. In fact, we have an email later today from an advisor asking an almost identical type of question about hedging a broad-based S&P portfolio. A lot of people who have a lot of clients with a lot of long equity positions that are somehow analogous to the S&P 500 like to turn towards or think they can turn towards the VIX as some sort of hedging tool. And they think that if they buy a VIX call, remember the VIX is an inversely correlated index, so as the underlying drops, the VIX should rally and vice versa. Not always the case, but that's at least how it's set up to work. And so people think that if they buy a VIX call, that if that will cover them in the scenario where the underlying drops and the market rallies. The underlying drops and the volatility rallies. And so that's what a lot of people come to VIX looking at it and that use case. And that isn't exactly perhaps the use case they should be looking at it for. Mark, you obviously work with a lot of retail and also some advisors, handling this type of product and walking them through the nuances of VIX and what they can and can't use it for. What's your take on the VIX as a direct portfolio hedge versus something more direct like, let's say, a put or a put spread?
I think there's some value there, but you really have to understand what you're doing and how you're doing it. Personally, I think for the overwhelming majority of advisors, the direct hedge makes a lot more sense. And for individual investors, the direct hedge makes more sense. For those, advisors or funds that are trading possibly multiple assets kind of across each other, that's where I think that using VIX is kind of a volatility hedge. So when you're getting short multiple products across multiple asset classes, and you're looking for a hedge, that's where I think VIX can really do its job. But, one of the problems is that when VIX is overly inexpensive right now, like, the VIX is 13.5 right now, the futures are usually trading at a huge premium up until the week before expiration. And if we do get a big move, there's no guarantee that the futures are going to really follow things along. So, you don't get exactly the hedge you're looking for when you're hedging a straight long equity portfolio. Other places where I think VIX hedging can work is, people that will do kind of long shorts against each other. Maybe there's some value there. But I think the portfolio managers that are running primarily long portfolios are much better served using a direct hedge.
Yeah, that's kind of been the take on pretty much from all of us talking on our various shows here about the direct versus indirect. I suppose you can call it controversy or a debate. But a lot of people come to this thinking like I said, they could buy a VIX upside call and then they'll be hedged in all cases in all scenarios. And what usually happens when people do something like that is they buy, let's say, a certain percentage out of the money VIX call, and then the market goes on throughout the period of that option to kind of vacillate, drop a little bit, rally a little bit, drop a little bit, rally a little bit. And those are the periods really where that VIX upside call or any sort of VIX component really tends to dramatically underperform, let's say just a direct put or a direct put spread on the individual product. Let's say in this case on the S&P, could be SPX, could be SPY, whatever options you're choosing to trade the S&P 500 with. That direct put spread is going to have a direct impact from the movement of the underlying and from the volatility. You're going to be able to see that and reliably count on that as a hedge factor. The VIX options and VIX futures, not so much. They're going to vacillate based on a number of different things, including the implied vol of that index, including the paper flow that's coming in and out of those products, the actual order flow. A lot of different things are at work in that VIX product, and you may have a number of days where the market may be slightly up and the VIX itself may be slightly up, or vice versa. And so if you're looking at a product to be a reliable hedge, that certainly is not the type of performance you're looking for. And what we've seen a lot of people actually have success with, in addition to what Mark was talking about, is when they hedge their direct portfolio exposure. Let's say they have a broad-based S&P 500 portfolio and they hedge it with SPY options or an SPY put spread. And then if they have a little bit extra money, and this is a unique scenario because, as Alan said at the top of the show, a lot of advisors are loath to pay money for put spreads or puts, let alone for a little bit extra. But if you are inclined to have a little bit extra protection, we've seen some people adding on a VIX component, usually a VIX call, could be a VIX vertical call spread as well, and using that as a kicker, if you will, in addition to the direct hedge. So the direct hedge will cover you in those near-term vacillating type sideways markets where you need a reliable, dependable, immediate hedge, whereas in the extreme moments, in the tail risk moments that Alan was talking about at the top of the show, where the market really is falling, the bottom has fallen out from the marketplace itself, those are the moments where the VIX itself and volatility itself tends to dramatically outperform a direct hedge like that. So that's a scenario where the direct hedge will cover you, but the VIX will really add a dramatic component. We're recording this a few weeks after the government shutdown. If you go back a few weeks and look at the VIX data from going into that shutdown and coming out of it and the weeks surrounding the period of the shutdown, you'll see VIX dramatically shot up and then came back down again just as dramatically. So it's a product that is known for dramatic, sharp, one-directional moves. That's something where a kicker like that could really outperform and add a lot of extra value to a portfolio. So if you are an advisor with a broad-based portfolio, and I know a lot of you are, like I said, one of you just wrote into the show today, then this might be an interesting way, an interesting use case for you to actually utilize the VIX product as a way to increase your returns without a dramatic outlay. Randy, in all the different overlays you're constructing out there, I know you're a fan primarily of just the direct approach, the direct put spread, and then writing some products to offset the price of that. Have you ever, in your variety of products you've constructed and variety of overlays you've constructed, taken this approach, gone and added some sort of volatility component, whether it's a VIX product or something else, as a bit of an extra kicker in those extreme environments?
Well, actually, we have. That's one of the reasons why Mark Sebastian is working with us right now. That's something that we've been adding to our portfolios over the last several months. I'll let maybe Mark comment on the types of trades we're doing on that.
Yeah, Mark, we've in a couple of cases, we've had some large income trades and other, short vol trades that we've been able to cheaply hedge using VIX convexity, so basically call spreads, against kind of the, if things had really gone over the cliff this last trip, we set up a couple of very inexpensive hedges against our basket 3 trades that we had on. So do we use VIX as a primary hedge against basket 1 and basket 2? No, but will we use it against some of our proprietary trades that we do? Yes, absolutely.
So, and then the other comments, the other issue we see a lot of people being confused with when they start coming into the VIX universe of products is the issue of the VIX itself and how it actually settles. It's not a typical option that you're used to seeing with a typical expiration cycle and things like that. They actually have a settlement process that they go through. And, I thought I'll look at the creators of this index, the CBOE. I'll see they must have some good language they use on their website to explain the VIX settlement process in very simple terms. And so this is what I pulled directly from their website. I'll leave it to you, the listeners, if this clarifies things for you or confuses you greater. This is their language and how they determine when the VIX settlement date actually occurs. They say the settlement date for VIX futures is the Wednesday that is 30 days prior to the third Friday of the calendar month, immediately following the month in which the contract expires, aka the final settlement date. So I'll leave that up to you if that actually adds more confusion than it solves. But the process itself has been ripe with confusion, and it is an interesting one in and of itself. We won't go too in depth in it right now because there can be a whole show devoted just the nuances of how these contracts settle out. But I think what you need to know for the processes of this show is really that going into that settlement process, whenever that date is, this month, October, we're recording this 2013, the settlement occurred on October 16th, which is a Wednesday. Going into that period, you're going to have some extra risk because there is uncertainty upon where the VIX is actually going to settle, where those prices are actually going to close, which of course impacts the actual value of those options and futures that you're holding. Mark, I know you spent a lot of time looking at VIX settlement and complaining about it as well, as a lot of people have. Give our listeners any quick notes you want to add without confusing them immensely about the VIX settlement process and why they may want to avoid it in their VIX trading.
Yeah, well, the key thing is it's based primarily on trades, not just quotes, like the normal VIX. So typically we'll see, especially in a lower VIX environment, it's not unusual to see a VIX print for settle that is well outside where the VIX actually traded, at the time. So I've seen situations where VIX is 14 and the print is 14, somewhere between 14.5 and 15. One thing I do know is that for people confused by settlement, CBOE does have a spreadsheet that you can use that will actually calculate based on the month and the year when the actual settlement date is. And I think the final key is you have to be aware that the final day of actual option trading, much like the SPX, is the night before. So the last real option trade in VIX is a Tuesday night, not on Wednesday.
So a lot of confusing elements to add to the equation. Let's leave it at that. If you have options going into settlement, you probably want to close them out ahead of time to avoid that risk. That's just a good process with options trading in general, closing out positions going into expiration as well to avoid any sort of last-minute issues or risks. Same thing with VIX settlement. Approach it the same way. If you have outstanding positions, particularly outstanding shorts, and you're worried about where the VIX may actually settle, then definitely close them out going into that process. I should mention as well here that we're talking about VIX and VIX options, but there is indeed a universe of products that all key off of or trade around the VIX in some way, shape, or form. You may have seen a lot of them out there. Some of them have become very popular, like the VXX, which is an ETP that trades off of the VIX and has become extremely popular. Some days is one of the most popular exchange-traded products by volume, which I think surprises a lot of people. Some of them are a little bit more infamous, like TVIX, which had a infamous explosion about a year and a half ago now. Still trades, surprisingly, but was constructed so poorly and had so many other structural issues that it ended up just really causing that product to be just a terrible overall product. But what I'm getting at is that there's a universe of products out there that key off the VIX and trade off the VIX in some way, shape, or form. All these ETPs and ETFs, they're long VIX, maybe they're ratio VIX, maybe they're short VIX. They could be all kinds of different constructions out there. And the moral of the story is really you get what you pay for with these products. And if you're going to dive into these things, you really should understand how they perform and how they work and how they're constructed, because that's really the key to it. Even some of these more popular ones like VXX are still controversial to a lot of people in the options community because they don't think they're really constructed that well. In fact, Mark, I know you've been a long-time naysayer on VXX. Are you still in that camp?
Yeah, well, the thing that you've got to recognize about most of the ETPs, and actually Doug Cass put out a column on it today, so that's how mainstream bad VXX is. But the thing you've got to recognize about the ETPs primarily is that in the very immediate, so in the today and in the tomorrow, their price is determined by movement in VIX. However, in the long term, over the life of the product, it is essentially a completely determined by contango. And so if the product is one where it is long contango, it is going to lose money. And if it is a product that is short contango, over the long haul, it will likely make money. That is just something you have to be aware of. So it's really about contango, and so these products, if you want to day trade them, or in very specific circumstances, they can do the job. But over the life of them, not as well.
Yeah, so exactly. Be careful what you're trading, what you're diving into. If it's an extremely illiquid product, that has its own problems and concerns, regardless of how well the product is constructed. But even like we said, some of the more liquid ones, they still have their issues. I mean, we're talking about an ETP that is based off a derivative, essentially of a derivative. So you're getting many layers removed from the actual underlying product. And there's also some debate, and that's still yet to be determined, the exact impact of all of these different products, these ETPs that trade off of and buy and sell VIX futures to hedge and VIX options, and what their impact is on the overall VIX product itself. Remember when we started this conversation, we talked about how VIX was just designed as just this general reading of the implied volatility of this particular index. Now we have a number that is the reading of the implied volatility of the index, but also takes into account the differing volatility skew of that month, as well as all of the buying and selling activity of all this universe of products around the VIX product. And so there is some debate as to whether perhaps some of these products at the end of the day, there is a bit of a tail wagging the dog, particularly towards the end of the day, where we see a lot of dramatic movements in the products and a lot of dramatic hedging activity, if that could indeed feed back on the product itself. So that's an interesting question, something else to keep in mind when you're trading the VIX product. But this is, again, just an overview of this product because so many of you out there are interested in it and want to trade it, want to use it. Some takeaways that you should have from this conversation before we roll on into answering some of your questions. First off, the number you see widely disseminated throughout the media, which is known as the VIX cash number, is interesting for some uses to keep track of kind of broad levels of volatility in the marketplace. But you need to know the context of where that number is being quoted, where the S&P 500 is, and where that number is, and that'll give you a much better sense of how valuable that is. But if you're trading the VIX itself, the number you really need to be focused on is the actual trading price of the future that corresponds to whatever options you're interested in. So if you're interested in front month options, you need to look at where the front month VIX futures are trading to have an idea of where that product is and where those options should be trading. The VIX cash, when it comes to actually trading the VIX, not exactly very useful. So when you hear that disseminated everywhere, keep that number with a grain of salt in the back of your mind. Secondly, The VIX product itself is not exactly a one-to-one negative correlation. So if you're going into it thinking that it is an ideal hedging tool for many hedging scenarios, you need to walk away from that assumption, because a direct hedge, a put or a put spread, whatever it is in the product that you're actually trading, will 9 times out of 10 outperform that VIX product, particularly in those intermediate scenarios, those times when the market is fluctuating up and down a little bit, moving sideways, not having a dramatic movement. Those are the periods where you could see reliable performance from a direct hedge. Where the VIX is useful and where it could really come into its own and add value to your clients' portfolios are in those extreme scenarios, the multiple sigma moves where the market is really selling off aggressively and the VIX is shooting north. Those are the scenarios where VIX will tend to just blow through your strike and many other strikes to the upside. And that's a case where that will add a lot of value to your clients' portfolios. And it's up to you whether it's worth the cost of buying those VIX options on a regular basis and rolling them, holding on to them for that one moment where the VIX is going to dramatically outperform, because they're relatively infrequent, a couple times a year at best. So if you're looking for that kicker, be aware of that. It's an infrequent opportunity, and you're going to have to spend some money and roll some options in order to capture it. But if you're okay with that, then it might be a useful scenario for you. And then lastly, we touched on settlement. If you have VIX options or futures positions open going into the settlement process and you're uncertain, when settlement is, or what the really settlement process is and how it works, then for the love of God, close those positions out, because you don't want that additional risk, or you can just roll them to the next expiration month and avoid having to deal with the uncertainty that surrounds the settlement process. So there you go. Here's a quick overview on the VIX product and how it might be useful in some of your clients' accounts. Mark, Randy, or even Alan, I'll open it to you. Any last words you have here on the VIX product before we dive into, or perhaps volatility in general, Alan, before we dive into the old mailbag?
The only thing I would is to underscore is to understand how the volatility can affect the prices of options and the mean reverting aspect of the VIX. At the same time, if you're doing a generic kind of volatility transaction, you want to try to just buy the appropriate insurance that you need for the portfolio. Understand the time frame that you need, that the portfolio is at risk. You don't want to overpay for insurance if you don't have to.
Well said, sir. And with that, we're going to keep on rolling into my personal favorite part of the show, because it's where you guys get to join us here on the program. It's the old listener mail segment.
Listener mail. Listeners write in. Mailbox.
All right, and welcome to the listener mail portion of the show. This is, of course, the portion of the show where you guys get to sound off and ask some great questions. And this first one is actually interesting, because I had someone actually call us up a couple of weeks ago and ask almost a very, very similar question. This is clearly on the minds of a lot of advisors out there right now who are sitting on some gains in their clients' portfolios, and they're starting to wake up to the hedging power, the value of options from a hedging perspective. This question comes in from Neal Tillman. He is a CFA, and he writes, "We're sitting at all-time highs in the market right now. Most of my clients' accounts are long equity. My average account is sitting on gains somewhere between 60 to 100K for the year. I don't want to lose those gains if the market corrects, but I also don't want to sell these positions and miss out on future rallies in the broad market." So right there is a ideal use case for options as a hedging scenario. Neal goes on to write, "For the sake of this discussion, let's assume I'm sitting on a $1 million portfolio with heavy exposure to SPY, which is, of course, the S&P 500 ETF. How would I insure this portfolio to protect a $100,000 gain using SPY options? How much would it cost me to protect that $100,000 gain through the end of the year? Your insight on this issue would be most appreciated." It seems like he had a portfolio that was worth $900,000 a few months ago. Over the course of these many rallies, that portfolio has appreciated to $1 million, and now he wants to hedge that near-term gain in the marketplace. Alan, I'd imagine this is a question you get some variation on all the time when you're out there talking to different advisors and asset managers. So walk our friend Neal here and indeed our listeners through what you would say in that scenario.
Yeah, if I could just speak in kind of generic terms, there's an exact formula on determining how many contracts are needed, and you would just simply divide your holdings value by the put strike times 100, and there's going to be a little bit of a rounding function that you're going to have to do in terms of how many puts you actually need, but you would round to the nearest round number, and this will give you the hedge that you want, and you'll just choose the strike price that you want in terms of where you're targeting to protect the portfolio. Now, that being said, Mark, I think there's actually a better way to do this, and that is to buy a put spread. So what you would do in this circumstance is buy a near-term put, the exact number of contracts represented by the portfolio's value, and then sell a further down strike, as further down put, the exact number of puts, and offset the cost of this the put. Very, very, very simple. The things that your investor is going to want to watch out for is how much does his portfolio actually correlate to something like the SPY, because remember, the SPY is representative of the 500 largest stocks. And if his portfolio is not highly correlated to that portfolio, he's going to have some risk in there, what we call specific risk from some of those component stocks that he doesn't own.
And you're right, Alan. The scenario that Neal here outlined is actually an ideal one for a put spread, because he's not concerned about that Six Sigma event. He's concerned just about that near-term correction and it wiping out some of the near-term profits he's accrued in that portfolio. So that's a perfect scenario for a put spread, where you just want to protect a very specific strip there in that underlying, and use the options to hedge you there. We don't obviously he didn't give us strikes, so I don't know. It's hard to kind of come in and give him specific numbers in terms of, I'm looking here at a variety of different SPY options. Remember, of course, you're dealing with SPY. SPY is a 1/10 product, so that's going to add a little bit extra wrinkle when you're calculating the number of contracts you need to use to hedge your broad-based S&P portfolio. The SPX product is also an idea for that. It's a little bit larger. It might result in some fewer contracts if that's your goal, to make it a little bit easier. But either way, they're both very suitable for that. There's a variety of different strikes I'm looking at here. You can leg into a lot of different put spreads. It's hard to pick an exact one without knowing the strike prices he's talking about. But in general, I think that's definitely the right approach. Hey, Alan, this is another one. I've received this question a lot. I'd be curious what your take on it is. A lot of advisors seem to write in. They want to know something on the variation of put spreads aside, just outright protection. What percentage of my portfolio should I be thinking about or willing to spend to get some near-term protection, like 2 to 3 months? Do you have a rule of thumb that bounces around in your head?
Yeah, there kind of is, Mark, and of course it's determinant upon the premium value of those puts. But in general, and this is very general, it's probably going to cost you about 2% to buy an outright put against a portfolio, and that's not an insignificant number. So that's why I think when you're looking at hedging a portfolio, you want to try and construct a strategy that reduces the outright cost of that hedge. Certainly, you still have the upside, no doubt about it. But if the market just stands still, you do have that inherent risk of that put option going to zero if you don't sell it out prior to expiration. And so that hedge can cost you 2%. So that's why, if you're going to do it, try to use a spread if you can.
So you and I are on the same page. So I told them about 2% as well. That's kind of the rule of thumb I was working from as well. So, Randy, anything you want to add here to our friend Neal? Obviously, you're doing a lot of hedging out there with puts. Anything you want to add to him in terms of what you might advise in this scenario?
Well, I agree with him 100%. We're dealing with that same issue right now, trying to how to protect the gains that have occurred this year in the market. Mark and I are working on the deciding how to rehedge for the following year. Of course, our strategy is more of a systematic, continual rehedge, so we're not trying to make calls in terms of whether or not the market's overvalued or is due for a decline. Just a general try to capture or try to lock in as many of those gains as possible. But obviously, I agree with the concept.
So, Neal, in a nutshell, we don't have the strike, so it's kind of hard for us to give you specific numbers. A good rule of thumb when you're looking at this kind of near-term protection, a couple months out, is about 2%. If you can live with that and allocate 2% of your gains towards hedging it for the next few months, then by all means do so. If that's a little bit expensive for you, there are ways around that. We've discussed collars on this program in the past. I encourage you to go through our archives and look at that. In particular, the zero-cost collar may be very attractive for you, particularly if you're not concerned about continued, prolonged, dramatic upside in the S&P 500 for the next few months. And also, like what Alan said, the put spread may be an ideal way for you to go to still get some of that downside protection, but mitigate the outlay. So just define where the strikes are that you want to actually protect yourself, and then see how much that put spread costs. Obviously, just buying one, selling the other, very simple math, and then you could see from there if that's an amount you're comfortable with. And then hopefully it works out well for you, Neal, as well as all the other advisors out there who all of your clients are sitting on gains and maybe starting to get a little bit nervous, a little bit antsy about what you're going to do with those gains. Last question here comes from a user who goes by the handle Alamo. Must be a Texan, one of your fellow Texans there, Randy. He writes, if I buy puts to protect a stock that I already own in my account, does that count as a sale for tax purposes? Is that a taxable event? Alan, I'm sure you've had this question about 75 bazillion times. That's a technical term. So why don't you give your answer for our friend here, Mr. Alamo?
Well, it's a very timely question because currently there's a tax proposal from Dave Camp that would calculate the actual put as if you were a sale against the stock. Now, that proposal is just that, a proposal at this time. So you're going to have just a situation where you're long a put and long the stock. You're going to take your natural taxes on that put option, and it won't reflect in the actual stock taxation.
And hopefully that proposal dies in committee and doesn't go anywhere. Because listeners, I think you could imagine the chilling effect that would have on the options market and financial markets in general if these hedges that you put on were automatically treated as if they were actually successful, that the underlying actually dropped and that you sold the underlying at that level, because that would just be extremely dramatic. I think there was another proposal that also treated covered calls as the same way. Isn't that correct, Alan?
Yeah, the proposal from the House Ways and Means Committee Chairman Dave Camp has some pretty bizarre consequences to implementing options overlay strategy. Any sale of a call option against existing shares would result in those shares actually being calculated as being sold. So again, I don't want to scare your listeners. This is a proposal that is being fought vehemently by the coalition, which is the group of exchanges that basically goes down to Washington to explain the consequences of these kinds of things. So gains on options now and associated stock are taxed as capital gains, but with this proposal, they would be taxed as ordinary income. So that, I think, is kind of it in a nutshell, if you will. I would say, the all-out exemption for this would be if you did it in a IRA or a Roth IRA, where you either have tax-deferred or tax-exempt gains.
So there you have it, Mr. Alamo. No need to worry. You can buy puts till your heart's content. Is not taxable. Obviously, the put is its own beast, and if it appreciates and you sell it, that's its own separate event. But if just buying the put outright against some stock is not indeed a sale, does not count as a sale for tax purposes. So don't worry. Hedge away and have at it, sir. And unfortunately, that is all the time we have for the advisor's option today. It was a great panel, a great discussion. I think we only dipped our toe into the waters of volatility and VIX, but again, difficult to tackle such a complex beast in just a 1-hour program. But at least we hope we whetted your curiosity. Of course, you can find more a variety of different places, including the optionsinsider.com. A lot of great radio programs and a lot of great content there about these products and these topics in general. Of course, you can find more at what is it again? Of course, you can find more at optionseducation.org, and in particular, click on the advisor tab there. You can learn a lot more, including all the great studies that you guys over there at OIC have cooking. And Alan, before you go, why don't you tell our listeners what's coming up over there at OIC that might interest our listening audience?
Well, I think the first thing that OIC will be involved in is next week we have the FIA Expo. So OIC was instrumental in terms of helping to devise some of the panels for around options at the FIA conference here. And we're looking to a great event. Last year, Mark, we had Hurricane Sandy hit, which greatly impacted the attendance. But from all accounts, it looks like this year is going to be a very good year for FIA. And for me, I'll continue to fight the fight everywhere, and we'll be in New York in a couple of weeks speaking to other people about the uses of options, and I'll be down at Schwab Impact on next week, which is an advisors conference, one of the biggest in the nation down in Washington, D.C. So I'll look forward to the next program, and I'll see you then.
Yes, I recall very well that Hurricane Sandy FIA show last year. We obviously do a lot of radio from that event, and our studio was quite empty for those 2 or 3 days because no one could make it into Chicago, as you might imagine. A lot of our listeners and a lot of our guests come in from the New York area, and that was a significant event. But before we go, also speaking of significant events, a lot of interesting stuff cooking over there in the land of Swan Wealth Advisors. I could go into it. But I think it's much better, Randy, if you explain it in more detail for our listeners. You have a lot of interesting new initiatives underway over there at Swan.
Thanks, Mark. Yes, we're extremely proud to announce that we're in the process of setting up a reinsurance company. It's going to be called Swan Reinsurance Limited. It's going to be a Bermuda-based insurance company that really, in my background as a CPA and working in the financial services group at KPMG in the 90s, have always wanted to do something like this. It's recently become cost. Prior to this, it was cost prohibitive to set up one of these type of deals. So this will be our kind of fourth product that we think is taking our defined risk strategy, the nature of a hedged equity plus option income strategy, combine it with very low volatility, low severity, high frequency business, combining 2 very low risk strategies to combine a very competitive product. It's going to hopefully provide a souped up rate of return to our already really good rate of return, but also provide it in a tax efficient manner. And we think it's going to be a big hit for us at Swan as well as clients. And it's also going to allow potential investors. We expect to hopefully take this public sometime next summer, which will allow most investors out there to be able to buy the stock on the exchange.
So in the meantime, if potential investors or just listeners to this show want to learn more, can they find out at Swan Wealth Advisors, or is there a special website to go to learn more about this?
They can contact me directly, go to the website, send me an email, or give me a call up to talk about it. I think the initial stages is we're doing the initial round of capital raising. We're going to do some Reg D offering, some 144A, and then hopefully do an IPO sometime next summer. So it's a process that's probably going to be 6 to 9 months in the making. But we're pretty excited about it. The business model has already been proved out by several other large money managers that have done this. Of course, everyone's familiar with Warren Buffett, and Berkshire Hathaway is essentially a reinsurance company also. So we're pretty excited about the product and the benefits that it gives to investors in terms of the higher rates of potential return, as well as the tax-deferred nature of the gains, and potentially trading at a multiple to book value. So we're pretty excited about it.
Yes, Mr. Buffett certainly has paved the way and showed the world the profitability of insurance and reinsurance. It's certainly what you guys do over there with overlays and risk mitigation strategies. It just dovetails perfectly with that type of scenario. So I think I'll be really interested personally to see how that unfolds over the next 6 to 9 months. And of course, listeners, if you want to learn more, contact Randy. His contact information has been on the show. We can put it in the show notes again for you, or just surf on over to swanwealthadvisors.com to learn more. And on behalf of Alan and Randy and Mark Sebastian, Mark, thanks for joining us again today too. Great to have you on this program as well. To bring you on more often to provide some insight for our advisors in the audience.
Oh, yeah, no, good seeing everybody.
All right, and on behalf of Alan and Randy and Mark, and of course myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this program, and of course for sending in such great questions. Keep them up, and we'll see you next time right here on the Advisor's Option.
The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by Swan Wealth Advisors. Since 1997, Swan has been the leader in hedged equity and option income strategies with GIPS verified results. Swan provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, the Swan Defined Risk Mutual Fund, or our proprietary option overlay strategies, please contact Randy Swan at swanwealthadvisors.com. Think outside the style box. Think Swan when deciding on risk management solutions to market risk. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.